I think. So this morning, a bit of news from me. Then we've got Andrew McHattie talking about the events in the sector over September. And then our guest this week is Tim Creed, who's one of the managers of Schroeder UK Public Private, which obviously used to be Woodbridge Patient Capital, and is currently in the news. So without further ado, let's kick off with the week's news. Lots of little bits this week. I just wanted to pull out a couple of things. One is to look at Vietnam Holding, and the other is to look at two of the Indian funds, the smaller ones. And there's a common theme linking all of these, which is tender offers, as I'll explain. Starting off with Vietnam Holding, as you can see, actually, after a period where it had struggled a bit before, I think sort of 2018-19, it's done much, much better recently, and it's been one of the best performing funds in its sector. Its discount has been stubbornly wide most of that way through that whole period there, and that's been a perennial problem. And so there've been various ways they've been trying to tackle that. They've got us involved to try and help market it a bit more. They've got new brokers in, and they've also instituted tender offers. This is one of the reasons I say we want to talk about this morning. The net result of that is that it's not very big. I think that's a shame, really. Although, as you can see, the discounts on all of these funds are relatively wide. There's no really very good reason for that. As you can see from these numbers underneath, Vietnam's actually been performing quite well, especially over the past 12 months or so. And as you can see, as I said before, it's the best performing fund over a year. Doesn't look quite so clever over 5 years. That's when it had its sort of performance wobble. But over 10 years, it's actually the best performing fund in the sector, because I think it would have outperformed Vietnam Enterprise, even if that was around. It's been going for 15 years. And it's focused on high growth companies with good ESG credentials, so it's environmental, social governance credentials. And that stood it in good strength. And I think it's exactly the sort of place where you want to be in these sorts of markets, especially with good emphasis on governance. The managers have been around for a long time. I think they've been there since launch, so that's their track record. And after the sort of terrible performance in COVID, the NAV has shot back up again and gone way past where it was before. So it's beaten its benchmark. Most funds compared to the Vietnam index, it's done way, way better than that. It's quite a sort of punchy, focused portfolio. The liquidity in the fund's improved a bit, it says, because it's gone to higher average market cap. That's largely, I think, because the stock's been doing so well underneath it. And definitely, the Vietnamese market is becoming more liquid and gradually more mature. At the moment, it's still classified as a frontier market. One of the things it's got to get over is this restriction on foreign investments, foreigners holding stocks, which does complicate things slightly. They keep talking about resolving that and not quite finishing it. But it's a much, much bigger market than it used to be. And it's a real winner within ASEAN. If you remember, we went to Robin Parbrook, Schroeder Asia Total Return, and he was saying this is one of the funds, one of the countries that he is actually interested in the area, whereas most of those he tends to avoid. The reason really is become its a sort of manufacturing center for the whole of Asia. So lots of Chinese firms have been switching production there, but also people like Samsung and Foxconn's manufacturing iPhones there. It's real kind of high-tech manufacturing too. So they're opening new electric vehicle plants. And because they're generating quite a big trade surplus, there wasn't one, I think, in the back end of 2020, but that's gone back into surplus again now. That's meant the currency is quite strong too. So whereas Trump was trying to accuse it of being a currency manipulator, that's definitely not true, and that case has been dropped. They maybe got a bit too complacent about COVID. They were extremely good at the beginning at controlling the spread of the virus in the country. They didn't have any deaths and hardly any cases to start off with, but they got caught out by the Delta variant. So they've been running around now trying to vaccinate people. 30% out of vaccination now. They've just approved, actually the Cuban vaccine is one of the ones that they're just taking on, but they're getting vaccines from all over the place. It doesn't seem to be holding back the manufacturing so much now that they did for a while, but it is affecting the tourism sector, and that's one of the things that needs to reopen for the whole country to go sort of full speed. Now, this fund promised a tender offer at the end of August at a 2% discount to NAV, and it was kind of overwhelmed with people wanting to rush for the exit. 67.5% of the shares were tendered, and it's ended up paying out almost $60 million. I think that's entirely unjustified, really, given the strength of performance, definitely the recovery in performance that it's seen. I think if it can sustain that just another 6 months, then the sentiment towards this fund is going to change quite significantly, and people will be coming to get back in again. So it's just unfortunate that this thing has shrunk so much, but because it's now less than 100 million, people start to say, oh, it's too small. So I would really like to see that re-expand again. Now, Indian funds, the two we're talking about this morning are just Ashoka and India Capital Growth, or Ashoka. They are also the two best performing funds in here. Ashoka is more of a all-cap fund. India Capital Growth is more of a mid and small cap fund. So the two of them have got a bit more mid and small cap exposure than the Aberdeen New India and JP Morgan Indian do. But Ashoka is sort of in the middle between the three. Here we are, some price and discount charts. Obviously, the India Capital Growth one goes much further than the Ashoka one does. And the Ashoka one's tended to trade around asset value ever since launch, whereas India Capital Growth's really struggled with this discount. And it's been marching back in again recently, and I think it's got further to go. To my mind, it's a bit unjustified that there's no really good reason why India Capital Growth trades at a much wider discount than the other one does. So this one, Ashoka launched in July 2018, so it's just past its third birthday. That's quite significant, as we'll explain in a minute. And it's led by a chap who's sort of ex-Goldman Sachs. And the reason why the 3-year anniversary is significant is because it doesn't charge a management fee in the normal course of business. So the way the manager gets paid is a performance fee, which is quite chunky, as you can see there, 30% of the outperformance of the benchmark over 3 years. That's capped at 12% of NAV, which is great. So the first period just ended, and the managers earned about £7.9 million on this £160 million fund, so which is about 5% of NAV. That's all been provided for in the NAVs as it's been going along, so there's no sudden shock to the NAV. Nevertheless, it's not too bad. I thought they were very brave to do this at the beginning, but it has been rewarded for them. It offers an annual redemption facility at NAV, which is, again, quite brave. This year is the first year that it's had a lot of shares handed back to it. Slightly strange because it was trading at a premium. But actually what I think has happened is that Aberdeen Emerging Markets, which we know is being rejigged to become a Chinese fund, needed to exit its holding and decided to do this through the redemption facility rather than try and sell them in the market. They've managed to place 4.4 million of those with other buyers, so the fund actually won't shrink by that much. But there we go. By contrast, India Capital Growth, which has been around for a lot longer, is already a little bit smaller. I quite like Gaurav. People probably would have heard him talk in the past because we've done various things with him in the past. He's got a lot of experience in the sector. His performance, again, a bit like Venom Holding, went through a wobble. It's come screaming back again. They just announced results for the first 6 months of 2021, where they've been outperforming, and the NAV and the share price are hitting new all-time highs. The discount has been narrowing, so they've got it down into single digits now, which is great, but it could have more to go for. But they've offered a redemption opportunity at the end of December, and again, it's for up to all of your holding if you want to. but it's at a 6% discount, and that may be the thing that stops it shrinking too violently. I don't think it deserves to be to shrink at all. I think the performance justifies people hanging on to it. It helps probably that Aberdeen Emerging is not shareholder in this one, so that there's no sort of big institutional shareholder looking for an exit. But nevertheless, it's something that they've got to contend with. If those shares are going to get in place around 6%, I think the idea is to try and keep the discount narrow going forward. So it might not be a bad buy even at 6% discount. They are quite different funds, as I was saying before. I just wanted to tick this up just to show you that there are no holdings in common. So that probably shows what the direct opportunity there is in India. If you remember again when we were talking to Robin, he was saying that he thinks that India is going to be the beneficiary of the fallout of what's going on in China. So as the more Xi and the Chinese Communist Party interfere in the running of Chinese businesses, the more people will be looking to someone like India as another fast-growing emerging market, and with huge potential, decent rule of law. I think it's probably quite a good alternative to putting money in China. So these funds, I think, deserve to keep expanding rather than shrinking. Right, just to finish up with me, just following up on a few bits and pieces that we've talked about in the past, just bits of news that happened this week. First off, if you remember going back to August, we talked about a vote that was going to happen in Berlin. So 56% of voters in Berlin, as part of this general elections, approved a referendum on compulsory repurchasing flats from large landlords. And we're yet to see whether that's actually going to happen or not, because it's going to totally depend on who ends up running the city government, and then about how they're going to fund it. But the SPD, which is the socialists, have already said, yeah, we didn't like the idea, but since people have voted for it, we're going to abide by the result. So I think we could actually see this happening. The effect, if you remember, is not to Phoenix Spray, which is the one that's listed in London, but more to Deutsche Wohnen and Vonovia. And it's interesting, actually, that they sold some flats back to the Berlin government just ahead of this. So it's going to be interesting to see what happens. People like Capital Gearing are invested in it. Asset value investors, again, we've talked about this saga with Third Point in the past. They're having a third go. They've written another letter to the board of Third Point to say, please, will you put our requisition to a vote? The Third Point board have said it doesn't stand up in law. Asset values say our lawyers disagree. We'll just have to wait and see what happens with that one. Another big bit of news that would have been much bigger in the past this week, but actually because of what's happened, it's no longer quite such a big fund. But Catco Reinsurance might be about to disappear because they managed to come up with a plan to buy out the remaining portfolio. So that just can end with just a cash exit. And then, as Mr. Creed's going to talk about in a minute, we highlighted the Oxford Nanopore IPO coming up, and obviously that seems to have gone quite well, which is going to be great for Trade UK Public-Private. So that's enough from me. Let's now hand over to Andrew McHattie.
Great, thank you very much, James. I'm just going to switch my screen as usual, and we'll talk about the movers for the last month. That was interesting what you were saying about the single country funds, James, where timing is obviously always important, and inevitably there's some single country funds appearing on the list of risers and fallers pretty much every month. September was no exception. We can see that JP Morgan Russian Securities is on the list of risers here, and a couple of Japanese trusts as well. In terms of themes, there are a couple of risers here from the energy sector. So Geiger Counter, which I'll come on to, probably counts there, Gulf Investment Fund and Riverstone Energy. Other than that, I think it's really special situations. And we can see that Schroeder UK public-private is on the list here. It's had a good rise. And I'll just doff my hat to you, James, because you did point out a couple of weeks ago that the Oxford Nanopore flotation could give that trust a boost. So the ones I'm going to talk about there are Geiger Counter, Acorn, and Seraphim Space. So I'll come on to those. But a quick look at the fallers over the month. There weren't too many, actually, falling in double digits. And these are pretty punchy trusts on the whole. So most of them are not really too much of a surprise. Things like Bailey Gifford China Growth is obviously volatile. Augmentum FinTech, you might expect it. And certainly McHattie Property Opportunities, which was a very regular feature on the list of fallers for quite some time in the past, is back again. But the one I'm going to talk about there is Civitas Social Housing. I'll come straight onto that. I talked about this last month, actually, when with hindsight, I can see I didn't quite have the full story at that time, because there were a couple of public factors there which had obviously started to depress the price. The first thing was negative comments from the regulator of social housing about Auckland, one of the big care providers that Civitas works with. And that didn't seem anything out of the ordinary, really, that Civitas would be unable to cope with. The other thing was that actually was quite poor timing. Civitas had been planning an equity offering to expand and had obviously told the market about this. And that was perhaps an overhang for the shares. So, there were reasons why the premium was already under pressure. But then actually the major factor emerged subsequently, which was that there is a short seller who's been chasing the shares down under the name of Shadowfall. Actually has quite a successful track record, a pretty good short seller, I think. James is not sure. Anyway, the Sunday Times had a report on this, which really did knock the shares quite badly. And as a result, they've been relegated from the FTSE 250 index, and that, of course, caused some index selling as well. So the selling basically has gathered more momentum and sent the shares further down than I had anticipated. And the allegations, I think, from the short seller have been addressed and rebuffed, actually, pretty vigorously by the trust. One of the main things there was that that there have been some transactions where care homes have been bought and then the operational side has been split from the property side, and a couple of Civitas directors or managers have been involved in the transactions. So there was some dirt thrown about with regards to the related party transactions. Now, I have looked into this quite carefully, and I believe that actually Civitas discussed all of this with the UK Listing Authority and decided that the transactions didn't need to be disclosed. But obviously, you can form your own judgment on that. What I would say, though, is that I've been following this trust for quite some time. In fact, I started to follow it really in 2019, around this point here, when it has suffered what looks like an incredibly similar fall. And in fact, for quite similar reasons in a way. This was when the regulator for social housing was a new formation that started to issue edicts, and the worry in the market was that it was really going to bear its teeth and cause trouble for Civitas. And so we did see this quite sharp decline from about 115 down to 75 at its trough there. But Civitas very gradually managed to rebuild confidence in its strategy, and the shares went up to 120. Now, I can't say that that's definitely going to repeat, but it seems to me that there's quite an analogous situation now. And I would say that given what has happened, you might argue that the risk is somewhat elevated from where it was a couple of months ago. But in my view, the opportunity is also very much greater now. So if you are prepared to take on those risks, I think that could be worth further examination, actually. I quite like it. I'll move on from that to something a bit more straightforward, which is Geiger counter. This has had a great month, and it's really been a beneficiary of the rise in natural gas prices, which you will have undoubtedly heard about. And uranium has been a sort of side beneficiary, because if other forms of electricity generation start to become much more expensive, then it brings nuclear power back into the frame. And so the uranium price, which is not publicly traded, I mean, there's no public market in uranium like there is for iron ore or copper or for oil and gas, but the trading prices are collated on a weekly basis by various people, and you can find those on the internet. So the uranium price is around $43 a pound. And at the end of July, so start of August, it was around 33. So it's had a sharp increase of around a third. Part of that is down to buying by investment funds. And there's one in particular, which is called the Sprott Physical Uranium Trust, which is the largest physical uranium trust in the world. It's a Canadian open-ended fund. It's 1.3 billion US dollars. And they actually buy physical uranium. So that has clearly been a big factor, I think, in this rise, as well as potential demand coming from the nuclear industry. And for the first time now since the Fukushima disaster in Japan, the International Atomic Energy Agency has forecast a rise in nuclear power generation over the next few years. So I think there is something of a shift going on. We'll have to see whether it's temporary or not, depending on what happens to energy prices. But Geiger Counter, which doesn't invest directly in uranium, it's investing in uranium companies. And you might expect that to be somewhat geared, actually, to the uranium price. It's trading at a premium to asset value now. There shouldn't be any lag in the asset value there, because it's mainly investing in quoted companies. So we'll see what happens there. But I would imagine we might see more volatility to come. Acorn Income Fund, again, we've spoken about this before. It's winding up. I just wanted to point out something technical, actually, for people who might be holders, which is that trading ceases in a couple of weeks' time. I just wanted to remind you, actually, that the default option here is that your shares will roll over into the open-ended unicorn fund. And I'm not passing any judgment on that. It may or may not be a good option for you. But if you do want the cash, then you do need to make an election with your stockbroker. So don't miss out on doing that if that's your plan. Obviously, you have to do that before October the 12th. My sense is that being patient here and going for the exit is better than selling in the market. You can see from the chart here that the share price is below the asset value. It looks as though the asset value has just had a bit of a dip, actually. And that's not really down to the market fall. That's down to the shares going ex-dividend yesterday. So that did knock 7.5 pence off. Even so, the selling price in the market is 395 today, and the latest NAV was 431. So even if you're taking some costs off that, I think you should be better off waiting for the payment. Finally, and this is fairly brief today, Seraphim Space Investment Trust. I did talk about this back in July, just before the launch. And it wasn't particularly well received at the time. I mean, it raised £178 million, which is a decent sum, but I think it would have liked more. I can't remember exactly what it was going for. I think it may have been 300, but it didn't get everything it was looking for. So not received with enormous enthusiasm at the time, but since then, it's really had a fantastic run higher. And now the price is about 124. Now, as you can see from this, the flat green line here, the public NAV hasn't shifted. I don't think that's necessarily a useful indicator, but it does, of course, cause you to pause and think and wonder whether this pretty sharp rise in the share price is justified or not. And I do worry about this with some IPOs that seem to leap off with great enthusiasm in spite of an absence of news or real NAV events. And one example of that was Hydrogen One, where I felt that the share price had really gone up much too sharply in the initial phase, and said so. But it did get up to 116.5, that trust, and has now fallen back to 104. So I did wonder with this trust whether that might also occur, and you can see it has come off its peak here. Actually, though, I think maybe not, and I would tend to give this one a bit more room to grow. And the reasons for that are really twofold. The first thing is that this is an utterly unique trust at the present time. If you want to gain exposure to the potential growth from the space industry, then this is how you do it. I don't think there's any publicly listed alternative certainly for retail investors at the moment. So I can understand that the shares might have scarcity value, which would be able to sustain a premium over a longer period of time. The second reason is maybe a bit more interesting, which is that the trust has been actually busily getting on with exactly what it said it would do. And it's fulfilling the deals which it said were under progression. So in a couple of cases, they were SPAC deals where companies had to reverse into the shells, and those have happened. And it has made a follow-on investment of $25 million into a company called Isotropic Systems. And this is interesting because this is a British company, actually, that makes specialist satellite receivers, which enable you to pick up the signals from satellites. And they are completely different from many others, because normally with a satellite receiver, it locks on to a single satellite, and that is the only one you can collect the signal from. With the isotropic ones, they can actually connect to multiple satellites, which enables you to switch between them. And they have quite a significant technological lead here, which is really interesting. And I think that could well help actually many people to gain access to very strong broadband, which they can't currently do. And that applies to lots of emerging markets. I mean, really quite a big chunk of Africa is not currently internet enabled. And also, there are lots of applications for transport, for example. And the company itself gives the example of super yachts, which, of course, if you own a super yacht, you have the budget to make sure you can get pretty decent broadband access. And so that's all taken care of at the present time. But the market there is roughly 7,000 super yachts. And the Isotropic says there are 4 million fishing vessels that don't have broadband access. And so if you can make it much easier and cheaper and have a small receiver to help you obtain this, there's a huge market there. And the same applies to coaches, to airplanes, and to the military, actually, which really needs good broadband access. So there are lots of applications here. And that's perhaps one reason why Isotropic has been able to price the latest funding round at a valuation that was 172% higher. And Seraphim already had a small holding here, so it did get an NAV bump from that, obviously not reflected in the public announcement yet. I think that illustrates the potential here, which is huge. It's still a leap of faith and very early days, so undoubtedly this is still a very speculative trust, and you would need to, I think, expect some bumps in the road, but you could just sit tight on this one and let it run. So with that example about the fishing, I'll let you carry on trawling, James, and speak to Tim. Thank you very much.
Great, thanks very much, Andrew.